Hey guys, how's it going? It's Alradom Chaiki and welcome back to my YouTube channel. In today's video, we're going to talk about dividend investing. This will be an ultimate beginner guide to dividend investing. We are going to unpack what dividends are, how they work, how to pick a dividend stock, and the power of dividend investing and compounding effect. So to understand dividends, they are a distribution a company makes to its investors. When a company makes excess earnings, it may choose to distribute some of its earnings to shareholders. Usually it's in the form of cash, so you will receive cash. Some do have an option of paying dividends in the form of extra shares, so that is at the discretion of a company. Typically in South Africa, dividends are paid annually and semi-annually. So basically dividends are a reward to shareholders for investing in a certain business. Dividend investing can be a great investment strategy because dividend stocks provide two sources of returns, being regular income in the form of dividends and a capital appreciation whereby share prices actually increases over time. So this total return get to add up over time, and then you're gonna get an accumulation of the share price increasing and dividends on top of your existing investment. So dividend stocks tend to have less volatility, reason being that they provide a consistent cash flow. So usually dividends are held for long term. They are not usually held for trading. It's very much rare to find that a person is investing in a dividend stock simply because they want to just hold it for a short term or sell it in the coming year. But what usually happens is people buy dividend stocks and then after receiving dividends they sell those shares. But generally dividends are mostly held for long term, not for trading. For example, if this company A trading at 10 rands per share and is a paying dividend stock, you know that regardless of the movement in the share price, you are going to get dividends regardless. And if the share price increases, you are going to get rewards in the form of capital appreciation. So there isn't a lot of speculation that goes into dividend stocks. So they are a bit more safer simply because they pay dividends. When a company does not pay dividends, you know that if the share price is 10 rands today and in 6 months time it has appreciated to 60 rands, you are going to sell your shares because you would want to realize your gains. And that is because you don't know how much the share price could be in the coming year. So there's a lot of speculation that goes into companies that do not pay dividends as compared to companies that pay dividends. Uncertainty wouldn't be a big deal when you're investing in dividend paying stock because you know that you're going to get rewards regardless. So how dividends work is that if you have 1,000 shares in a company that is going to pay dividends of 10 rands per share, you're going to receive a total dividend income of 10,000 rands. And what you do with the cash is totally up to you. You can either spend it, save it, or invest it in a totally different company, or reinvest it in the company that paid out that dividend. Now this is the advantage of dividend investing because you'll be accumulating more shares and automatically compounding effect will take place. So how compounding effect works with dividend stocks is that if you had 1,000 shares before receiving those dividends and then receive dividends of 10,000 rands and the share price is 10 rands, when you reinvest the money you will buy an additional 1,000 shares, and not with your money this time but with the money that you would have received from your dividends. Then you will receive more dividend income in the next payout. So dividends reinvested increases the value of your total investment, and then it's going to be a cycle that happens all the time for as long as you reinvest your dividends. Dividend investing is a great strategy to adopt when you want your money to work for you, to just make money while you're sleeping. You need to make sure that you pick the right dividend stock. So before you invest in any dividend paying stock, you need to do some evaluations. The first thing being the financials. The company needs to be profitable, have a great positive cash flow, and a strong balance sheet. Remember, you want to invest in a company that is most likely to pay dividends for forever. So they need to be profitable in order to sustain the dividends that they pay out. So a green flag will be a company that increases profits year to year, increase their assets, and also reduce liabilities. So if liabilities are to increase, especially long-term liabilities, it should be for a good cause. Maybe the company would have taken a loan to fund their operations or to invest in something, but liabilities should increase when it's for investment purposes. But that can be excused, especially if a company is financially positioned well and they have a positive cash flow. But liabilities cannot consistently increase because an increase in liabilities result in an increase in borrowing costs. And borrowing cost is a statement of profit or loss item. So when borrowing costs increase, profits decrease. So the consistent increase in liabilities without the consistent increase in revenue will result in a decrease in profit. And such company is most likely to cut dividends because they wouldn't be affording to pay dividends or to even put more money into their reserves or invest back into their operations. And if a company continues to pay dividends even though they are not financially positioned well, it's a red flag. Secondly, you need to look at the dividend payout ratio, which is the total amount of dividends paid out related to the net income of the company. If a dividend payout ratio is 50%, it means that the company is paying 50% of their profits to shareholders and the other half is being retained or invested back into the business. The dividend payout ratio is used to assess the dividend sustainability of a company, so it has to make sense. For example, if a company has excessive debt, it cannot pay 75% of their profits in dividends, because with how much are they going to pay the debt and reinvest back into the business, and how are they going to sustain dividends? That is why a high dividend yield trap is a thing. So a high dividend yield trap is when a company is struggling financially, has excessive debt, but they have a high payout ratio and a high dividend yield. They just do so to keep the investors invested into the business, even though they know that they are unable to pay dividends. And by being unable, I mean they don't have that much positive cash flow, or they even have a negative cash flow, or they don't have any money in retained earnings. So it does not make sense for them to pay dividends, but they continue to pay dividends, increase them, and have a high dividend yield. So such company, usually they are dividend trappers, if I should name it like that. Then there's a dividend yield, which tells you how much of the share price is being paid out as dividends. If a company pays 2 rands in dividend and the share price is 20 rands, then the dividend yield will be 10%. A high dividend yield is better, but it does not always mean that the company is a good stock. Reason being that dividend yield is affected by share price, and share price fluctuates all the time. So a high dividend yield may be a result of a declining share price. For example, if a company pays 2 rands in dividends and the share price declines from 20 rands to 10 rands, the dividend yield will be 20%. So a dividend yield can be misleading if you look at it alone and might end up investing in a dividend trap stock. Thirdly, you need to consider the earnings per share. The best dividend stocks are companies that have regularly shown the ability to increase their earnings per share and increase their dividends. Total earnings and earnings per share are very much important to investors, as this can prove that a company is able to pay dividends. So if dividends per share tend to increase, it should be that earnings per share have also increased, because it wouldn't make sense for a company to increase dividends per share yet their earnings per share are declining. So the two need to move in the same direction. Lastly, you need to look at the dividend history. You need to consider a company that has been paying dividends consistently for so many years, at least 10. What I do is I look at a company that has been paying dividends for 10 years. Because if you are a dividend investor, consistent income, especially dividend income, should be the goal. So you can't invest in companies that often cut their dividends. So what you need to avoid is companies with excessively high dividend yield, history of inconsistent dividend payments, companies heavily relying on debt, and weak financials or declined earnings. For a quick example, we are going to look at XOXO Resources. I'm going to go to their financials, and the first statement is the income statement, where we see the company's profits. You can see that from 2019 the revenue has been increasing and the net income has also been increasing. The net income shows the profit of a company after it has paid all of its expenses. So XOXO is a very profitable company, and for them to be able to increase the net income, it's remarkable as a dividend paying stock. And then going to the balance sheet, you can see that their assets also are way more than their liabilities. So this company, if it was to decide to be debt free, they can just convert their assets into cash and pay all their liabilities and still have some of the money left. And that actually is great for a stock to have such a strong balance sheet, because the asset has to always be more than the liabilities. And going down, you can see that the debt to equity ratio is 19%, and this shows that they are not heavily reliant on debt, which is a great thing, because then they'll be able to sustain their dividends. Going to cash flow statement, the cash flow statement shows the amount of money that they have in their bank and them having a positive cash flow, because a lot of companies don't have a positive cash flow. It shows how healthy they are financially, and for that actually shows that they are able to pay their dividends. They have a bit of a high dividend yield, we are going to see it now, but they are able to sustain their dividends. They have a dividend yield of 13.46%, which is a bit high as compared to a lot of stock, especially in this economy. And the payout ratio is 57.42%, which is good, unlike when it was maybe 75%. That would be a bit of a red flag generally. But a stock like XOXO, with less debt that they have and a positive cash flow, they are able to sustain their dividends, and having a payout ratio that is that reasonable, they're probably in the best position to be able to pay dividends for the longest time. And scrolling down there, you can see the dividends that they have paid. They're going to pay another dividend, I think 1st of October, yes, and the ex-dividend date is September 27, and they've been paying dividends consistently since 2020. It hasn't been a lot of years, but the fact that they were able to pay dividends in 2020 and they have been paying since then, and being a financially healthy company, I don't have any doubts that they will cut their dividends soon, but we never know. But this is an example of, according to me, a good dividend stock. So we have come to the end of the video. I hope you've enjoyed it and it was very much insightful. Don't forget to like, comment and subscribe, and I'll see you in my next video. Bye.